Warren Buffett earned almost all of his fortune after turning 50 years old. This is not a typo and not an exaggeration. The man known as the greatest investor of the century became truly wealthy at an age when most people are already thinking about retirement. And the reason is not luck. The reason is that he never made one simple mistake that almost every beginning investor in America makes today. In a minute, you will find out exactly what it is, and you will understand whether you are losing money right now. In this video, we will break down not just this one mistake. We will break down 5 specific traps that millions of people fall into every year here in the United States, opening a brokerage account with a dream of financial freedom. Some lose money by panicking during a market crash. Some take out a loan to invest in an asset that promises quick profit. Some buy shares of a company they do not understand at all, simply because the name keeps popping up in the news and in conversations with friends. Warren Buffett, over more than 70 years of investing, built his fortune by avoiding exactly these traps, not by chasing profit at any cost. His approach seems boring at first glance, stripped of excitement and adrenaline, but that very boredom became the foundation of one of the most impressive financial stories in the history of capitalism. Stay until the end, because the 5th mistake applies to almost anyone who reads financial news and thinks they understand the market better than they actually do. Warren Buffett was born in 1930 in the city of Omaha, Nebraska, and even as a child, he showed the trait that would later become his greatest weapon. At 11 years old, he bought his first shares of stock, and before that, he was already earning money delivering newspapers and selling chewing gum to neighbors. Even then, he was driven not by a hunger for quick riches, but by curiosity about how money works for itself. In college, he studied economics and fell under the influence of his professor Benjamin Graham, the author of the concept of value investing. This philosophy rested on a simple idea: buy a business for less than its real worth and wait for the market to recognize that. This principle, not any secret formulas or insider information, became the foundation of the entire empire that followed. Today, Buffett leads the company Berkshire Hathaway, which owns dozens of well-known brands, from insurance companies to ice cream makers and railroads. But it is important to understand the main point. His fortune was not built on one lucky deal or a brilliant prediction of a technology boom. It was built on decades of consistent, often boring and slow decisions. While other investors chased trends, he spent his evenings studying company financial statements the way other people read novels. That is exactly why people listen to him, including millions who live right here in America and make decisions every day about their own retirement accounts and investment portfolios. His word carries weight not because he is rich, but because his wealth was built on principles that almost anyone can follow, given patience and discipline. The first mistake Warren Buffett never allowed himself is deceptively simple. He never invested in a business he could not explain in plain words in under a minute. He calls this the circle of competence principle. The idea is that every person has an area they understand deeply, and everything outside that area becomes gambling rather than investing. Buffett has repeated the same thought many times. It does not matter how wide your circle of competence is. What matters is knowing its boundaries precisely and never stepping outside them. The clearest example of this principle came at the turn of the millennium, during the dot-com boom. In those years, the entire market was swept up in euphoria over internet companies. People poured their savings into startups with no profit, no clear business model, sometimes not even a finished product, simply because the company name ended in .com. Investors, friends, journalists, and even Berkshire Hathaway shareholders accused Buffett of falling hopelessly behind the times by ignoring the technology sector. His stock actually grew more slowly than the broader market during that period, and criticism came from every direction. But Buffett stayed true to himself, openly admitting that he did not understand how these companies planned to make money in the long run, and therefore could not judge their real value. When the dot-com bubble burst, trillions of dollars in market value vanished within months, and thousands of companies that millions of investors had believed in went completely bankrupt. Berkshire Hathaway, having stayed out of that frenzy, came through the crash almost unscathed. The lesson here is simple and applies to anyone living in America today, deciding where to put their savings. If you cannot explain a company's business model in plain words to a child, that is a signal to stop and not invest money, no matter how tempting the potential growth looks.
The second mistake Warren Buffett never allowed himself is panic selling during a market downturn. His famous line goes like this: "Be fearful when others are greedy, and be greedy when others are fearful." This is not just a catchy phrase for a motivational poster. It is a literal description of a strategy he applied in practice again and again, earning entire fortunes precisely in the moments when most people were losing money and losing faith in the future. The most telling example came during the global financial crisis of the late 2000s, when the mortgage lending market in the United States collapsed. The country's largest banks found themselves on the edge of total ruin. The investment bank Lehman Brothers went bankrupt, sparking panic on stock exchanges around the world. Market indexes fell by tens of percentage points within weeks, and millions of Americans, terrified, sold off their stocks and retirement savings, locking in enormous losses, just to avoid losing everything completely. At this moment of absolute fear, when it seemed the financial system might collapse entirely, Warren Buffett did exactly the opposite of what everyone else was doing. He invested billions of dollars into companies like Goldman Sachs and General Electric, buying their stock and bonds on terms favorable to him, because in the moment of panic, he was the one ready to act while everyone else was paralyzed by fear. A few years later, once the market recovered, these deals brought Berkshire Hathaway enormous profit. But the point is not just the numbers.
The point is the underlying behavior. While ordinary investors made decisions driven by emotion, selling assets at the worst possible moment, Buffett kept his composure and acted according to a plan made in advance. For anyone living in America today watching the swings in their retirement account or brokerage portfolio, the lesson is clear. A market downturn is not a reason to panic, and is often instead a signal for calm analysis of opportunity, provided of course you have a financial cushion and a level-headed plan. The third mistake Warren Buffett never allowed himself is chasing trendy assets simply because everyone around him was excited about them. He has repeated many times that in the short run, the market behaves like a voting machine, where the winner is not the real value of a business, but the mood of the crowd. While in the long run, the market behaves like a weighing machine that accurately measures a company's true worth. That is exactly why he never let himself buy an asset just because its price was rising and everyone around him was talking about it. The clearest example of this principle is his attitude toward cryptocurrency. As Bitcoin and other digital assets went through explosive growth, and thousands of investors across America, including very young people with no market experience, poured their savings into them, hoping to get rich within months, Buffett openly called such speculation a game with no real economic value. He compared buying an asset that produces nothing, pays no dividends, and creates no goods or services, to buying a lottery ticket rather than making a real investment. His business partner, Charlie Munger, put it even more bluntly, calling such speculative bubbles dangerous to the financial health of ordinary people. It is important to understand that this is not about any single asset, whether cryptocurrency, a trendy tech stock, or any other instrument surrounded by mass hysteria. It is about the underlying behavior. Buying something only because its price is rising and everyone around you is talking about huge profits is a classic trap that investors have fallen into throughout every historical era, from the tulip mania in Holland centuries ago to today's digital bubbles. Every time an asset rises purely on crowd emotion rather than a company's real financial performance, A painful correction eventually follows, and those who got in last lose the most. The fourth mistake Warren Buffett never allowed himself is investing with borrowed money and using leverage to boost returns. This technique in the world of finance is called leverage, and it sounds very appealing. Borrow money at a low interest rate, put it into a rising asset, and earn far more than the cost of the loan itself. On paper, this scheme looks almost flawless, and that is exactly why it attracts so many investors eager to speed up the growth of their capital. But Buffett always treated this strategy with extreme caution, and most often avoided it entirely. His reasoning rested on one simple observation. The market is unpredictable in the short term, and even a great investment idea can temporarily fall in price for reasons that have nothing to do with the real quality of the business. If an investor uses their own money, they can calmly ride out a temporary drop and wait for the price to recover. But if the money is borrowed and the asset's value falls, the lender may demand early repayment of the loan or additional collateral at the exact moment when the price is at its lowest. As a result, the investor is forced to sell at a loss, not because the strategy was wrong, but simply because the borrowed funds ran out at the worst possible time. Buffett called this situation the only real way to go broke, while starting out with a fundamentally correct investment idea. He pointed to countless wealthy individuals and entire financial firms that went bankrupt, not because of bad investment decisions, but specifically because of excessive use of borrowed money during periods of market turbulence. For an ordinary person in America, considering a home equity loan or margin trading on a brokerage account in order to boost potential returns, this principle matters enormously. Even a correct investment strategy can lead to total financial ruin if it is built on someone else's money rather than your own capital. The fifth mistake Warren Buffett never allowed himself is abandoning long-term thinking in favor of quick, immediate profit. He has often repeated one of the most quoted lines in the history of investing. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. This thought captures a fundamental difference between his approach and the behavior of most market participants, who check stock prices several times a day, react to every headline, and constantly shift money from one asset to another, chasing maximum short-term gain. A classic example of this principle is his investment in Coca-Cola. Buffett began buying shares of the company back in the late 1980s and has barely sold any since, despite numerous market swings, economic crises, and periods when the stock was worth less than the year before. His reasoning was simple. Coca-Cola makes a product that people around the world buy every single day, regardless of the economic situation, meaning the company can generate stable profit for decades. A similar story unfolded with his investment in American Express, which he has held for many years, collecting steady dividends and watching the share price multiply many times over compared to the original purchase price. The point here is not about specific companies, but about the underlying principle of patience. While other investors fidgeted, selling at the smallest dip and buying at the smallest rise, losing money to fees and taxes on every trade, Buffett simply held quality assets and let time and compound interest do the heavy lifting. For someone living in America today, building a retirement portfolio through individual investment accounts, this principle is especially valuable. Constant trading and chasing short-term profit almost always loses to simply and patiently holding quality assets for many years. Now that all 5 mistakes have been broken down, it is worth pulling them together into a single picture and understanding how these principles apply to the life of an ordinary person living in America today and managing their own savings. The first principle, the circle of competence, means a simple rule. Before putting money into a stock, fund, or any other asset, honestly ask yourself whether you understand how that company actually makes money. If the answer is vague or based only on advice from social media, that is a signal to stop and dig deeper before parting with hard-earned money. The second principle, Staying calm during a market downturn matters especially for holders of retirement accounts, like a 401k or an individual retirement account, who during moments of market panic often pull their money out en masse, locking in losses permanently instead of waiting for the market's natural recovery. The third principle, avoiding trendy hype, is a reminder to evaluate the real value of an asset, rather than following the mood of the crowd on social media and in the news. The fourth principle, caution with borrowed money, applies not only to margin trading, but also to ordinary consumer loans taken out to invest, which remains one of the most dangerous financial traps for American families. The fifth principle, long-term thinking, applies to virtually any kind of saving, from buying real estate to building a diversified stock portfolio over decades. What unites all five principles is one shared idea. Success in personal finance is not built on brilliant predictions of the future or lucky one-time trades, but on discipline, patience, and the ability to avoid the same obvious mistakes over and over again. Warren Buffett does not possess some magical ability to predict market movements better than anyone else. His main advantage is that throughout his entire life, he consistently avoided the traps that the vast majority of investors fall into, including those reading financial news today and thinking they have already figured out the rules of the game. Let's return to where we started. Warren Buffett earned almost all of his fortune after turning 50, not because he got lucky, and not because he had access to some secret information unavailable to everyone else. He built one of the most impressive fortunes in the history of capitalism simply by refusing to make the same mistakes that millions of people around the world make today, including anyone watching this video right now with their brokerage app open. He did not buy a business he did not understand. He did not sell in a panic when the market fell. He did not chase trends just because everyone around him was talking about them. He did not let himself take on risky borrowed money. And he never traded patience and long-term thinking for the temptation of quick profit. The most interesting part is that none of these five principles require a special education, insider connections, or a massive starting capital. Each one requires only one thing: discipline and honesty with yourself in the moment a decision is made. Ask yourself right now, how many times over the past year you bought something you did not fully understand, simply because everyone around you was talking about huge potential profit. Ask yourself how you behaved the last time the market dropped sharply and your portfolio lost value within days. Honest answers to these questions often say more about a person's financial future than any analysis or expert forecast ever could. If this video helped you see your own financial habits in a new light, hit like and subscribe to the channel so you don't miss the next breakdown of principles from the greatest investors of our time. And most importantly, pick just one of Warren Buffett's 5 principles today and apply it to your own money. Because the difference between an ordinary person and a truly successful investor is rarely about luck. It is almost always about discipline